Hi, welcome to another episode of Money Wisdom. I'm Rolf Dobelli, author of The Art of Thinking Clearly, which explains thinking errors. And I'm here to talk about the action bias. In a penalty situation in football, the ball takes less than 0.3 seconds to travel from the striker to the goal. The goalkeeper, who doesn't have time to watch the ball's trajectory, must make a decision before the ball is kicked. Football players who do penalty kicks shoot 1/3 of the time at the middle of the goal, 1/3 of the time at the left, and 1/3 of the time at the right. Goalkeepers know this, but they dive either to the left or to the right. They rarely just stand in the middle, even though roughly 1/3 of all penalty kick balls land there. Why do they jeopardize saving these penalties? The answer is appearance. It looks more impressive and feels less embarrassing to dive to the wrong side than to freeze on the spot and watch the ball sail past. This is the action bias. It says, look active, even that achieves nothing. What accounts for this tendency? In our ancient hunter-gatherer environment, action trumped reflection. Lightning-fast reactions meant survival. When our ancestors saw a silhouette at the edge of the forest that looked like a saber-toothed tiger, they did not take time to wonder what it was. They hit the road. We are the descendants of these quick responders. Back then, it was better to run away once too often. Now, our world is different. It rewards reflection, even though our instincts may still suggest otherwise. Being in a new or unclear situation accentuates the action bias, and that, of course, describes the financial markets. Many investors act more like young, gung-ho football players than calm, brainy chess players. They lack a clear investment strategy, so they compensate with hyperactivity. They think the more you trade, the better you'll do. That's completely wrong. So as an investor, how can you avoid the action bias? Number one, be an investor, not a speculator. Investors buy a security, seeking a decent return with a somewhat noble risk over a long period. Investors have a long-term horizon, but speculators trade to make a quick buck on price movement. Number two, if things are unclear, don't do anything. Hold back until you can assess your options clearly and calmly. Number three, beware that hyperactivity erodes returns that you would otherwise receive. Frequent trading increases your transaction costs, brokerage fees, and the like. And it makes you nervous, so you open yourself to decision errors. Successful investing is a patient, mindful, non-emotional activity with long periods of inaction. This mindset insulates you from the devastating effects of the action bias. Warren Buffett says it all. We don't get paid for activity, just for being right. In conclusion, in new or shaky circumstances, we feel compelled to do something, anything. Afterward, we feel better in the short term, even if we have made things worse by acting too quickly or too often. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
To watch more videos about making wiser money decisions, click one of these links here.